It's been a wild ride lately, but our tech stock portfolio is once again beating the S&P 500. This week, the S&P 500 was up 4.6%, but our tech stock portfolio was up 7.9%. This portfolio will always be volatile because it's only invested in one sector, and tech stocks, by their very nature, tend to be volatile. Our Wide-Moat strategy and capital light strategy are both also beating the S&P 500, and with less volatility than our tech stock portfolio. More about those two strategies later in the video. Hi, Professor Rex here. My college accounting students love tech stocks and love using what they learn in my accounting classes to pick stocks to invest in. So on April 29th, 2024, I started depositing $12.50 a week into a separate brokerage account, and we buy 10 different tech stocks each week. We invest only a small amount each week because I wanted to show my students they don't need much to start investing. And this graph is showing the growth of our tech stock portfolio over time as I invest additional funds each week. We have other portfolios too, including dividend portfolios, which are my favorite, so check out my other videos for information on them. There are timestamp links in the description of the video in case you want to just jump to a list of stocks we bought last week or any other section of the video. Here's the usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. So let's talk about the tech stocks we bought at the beginning of last week. On this slide are our ratings for the top 15 tech stocks as of last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday. Then we purchased the top 10 stocks. Note that all these stocks are higher quality, meaning they must have a quality ranking of B- or better. More on what makes up our quality grade on the next slide. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend growth stocks because some tech stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratios, etc. Our 10 highest rated tech stocks last week were Adobe, Applied Materials, Analog Devices, Arista Networks, Microsoft, NVIDIA, Accenture, NXP Semi, Synopsys, and Broadcom. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio. Risk is the first quality component. Tech stocks, like I said before, by their very nature tend to be riskier than most other sectors. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate companies' management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported earnings, also called profits. And finally, the last quality component is financial health. Remember, the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. This slide shows our best performing stocks in our tech stock portfolio last week. The portfolio was hit the hardest by the original tariff announcements, so that means it was also helped the most by the 90-day moratorium on tariffs. So if that 90-day moratorium on tariffs turns out to be just temporary and the tariffs are put back in place, this portfolio will probably get hit hard again. The best performers last week were ServiceNow, up a crazy 22.5%, Shopify up 16%, NXP Semi up 13%, along with CrowdStrike, and then we got Broadcom, etc. Now, one reason why tech companies may have been outperforming the market for several decades might be because they tend to require little capital. As a simplified example, if you want to start a software company, you just need a computer and software knowledge. On the other hand, if you want to start manufacturing cars or jets, you're going to need a lot of buildings, a lot of equipment, a lot of employees, etc. In other words, a lot of capital, which is very expensive to obtain and maintain. Now, Goldman Sachs recently published a research note that shows that companies that do not require a lot of capital have significantly outperformed companies that employ heavy capital by a whopping 544% during the period of 1990 to 2024. The research calculated capital intensity based on three formulas: assets divided by number of employees, assets divided by net income, and capital expenditures divided by net income. After finding this research note, I contacted the authors and discovered we might be able to get even better results, because in the study, they ranked and classified companies based on the 45 sectors of the ICB taxonomy. In other words, they did not base it on individual company formulas. So not only did they look only at the sectors, they took the sector's median since 1990. So if the sector's capital intensity changed over the years, they ignored that. The authors admitted that sectors that were once capital light can become capital heavy and vice versa. And they admitted that within a given sector, one company might be capital light while another is capital heavy. But they ignored that too. I'm assuming they did this to save time, because otherwise they would have to look at each individual company's factors for each month or week and then do this research for each and every year in the study, which is a lot of work when you're looking back over 30 plus years. So it seems their study could have had even better results if they dug deeper and looked at companies specifically instead of sectors in general. And we can do this in real time going forward on a weekly basis. So that's what we're doing, looking for individual companies that are capital light but also high quality. And our capital light rating is based on individual companies, not on whole sectors or industries. Before we look at the companies that are both capital light and high quality, let's first look at a list of the S&P 500 companies that are considered capital light according to the Goldman Sachs study. Once again, the formulas the Goldman Sachs study used were assets divided by number of employees, assets divided by net income, and capital expenditures divided by net income. So they're not difficult formulas, and you can do these rankings yourself. And since the study covered a 34-year period when growth outperformed value, on this slide, just for fun, I added our valuation column, which in this case is based solely on a growth methodology instead of our usual combination of two methodologies, one being growth and the other being deep value. But on the next slide, I'll show you which stocks we think are the best potential investments at this time, as we only want to invest in high quality companies. On this slide, I have a list of the S&P 500 companies that are capital light, high quality, and appear to be undervalued using our growth methodology. So far, this strategy is ahead of the S&P 500, but it's very early in using this strategy. So for this slide, I started with a list of over 4,300 companies, and the first step was to filter out the companies that were capital intensive based on the three formulas that the authors used in the study. I then filtered out all stocks not in the S&P 500. Then I ranked them based on a combination of our quality grade and their valuation. And on this slide, we have our top 15 companies. The top 10 are Nike, Adobe, Accenture, Arista Networks, Applied Materials, Thermo Fisher, Lowe's, NVIDIA, MasterCard, and MSCI. Now let's talk about a strategy I started tinkering with behind the scenes in September 2023. It's not the most diversified portfolio, so I decided to wait longer to share the results. It's a wide moat stock strategy. First of all, what is a moat? Well, Morningstar is a service that rates stocks and is famous for its moat rating that it assigns to large companies. So what is a moat rating? A moat rating attempts to simply measure the company's competitive advantages. If a company has no competitive advantages, then it's very easy for another company to enter the industry and take customers away from that company. They call it a moat rating because they liken it to a moat around a castle. If the moat is wide, then it's hard to storm that castle. If the moat is narrow, then it's a bit easier to attack the castle. And if there is no moat, then the castle is much easier to attack. So this strategy invests only in the companies with the best competitive advantages. In other words, the widest moats. Now there are limitations to the moat rating, and I prefer my own quality ranking system that takes much more data into consideration as well as the moat. But the moat rating is a kind of a quick shortcut way to invest only in high quality stocks. On the next slide, you'll see my ranking of the top 15 companies with wide moats, but first let's look at the strategy's performance. Like the tech stock portfolio, I've been making weekly investments into this portfolio. I originally had this strategy in a Fidelity portfolio with a few other strategies, but quickly learned that having several strategies in the same account makes it a nightmare to track their performance separately. So I sold off those holdings and have since started a Fidelity account dedicated solely to this wide moat strategy. The average investment so far has been held for less than a year and has produced a total return of 20.44%. Using Excel's rate function, that is an annual return of 44.63%. Now the strategies doesn't result in a portfolio with as much diversification as most of our other strategies, so the portfolio's performance could fluctuate a lot. And the performance likely won't stay quite that high because stocks historically average a total return of 10% per year. Now, Morningstar offers an ETF that only invests in Wide-Moat stocks. So that ETF is the natural benchmark for this strategy. Its ticker symbol is MOAT, MOAT. If we had instead invested in MOAT on the same exact days, we would have received a total return of 9.61% with the same holding period. Using Excel's rate function, that's an annual return of 19.97%. The strategy is also beating the S&P 500 by 17 percentage points on an annualized basis. Now let's look at our list of the best Wide-Moat companies as of Friday. In other words, the companies with the strongest competitive advantages. These ratings are as of last Friday after the market closed. The valuation methodology used is a growth methodology, not a deep value methodology. Remember, stocks in any of our strategies may appear on the list one week, but not appear the next week, as they might barely miss a screening criteria, such as earnings estimates over the next 12 months, which changes frequently. And just because a stock falls out of the ranking one week rarely means that we plan to sell. Sales tend to be rare. The highest rated companies as of Friday were Arista Networks, Adobe, NVIDIA, GE Healthcare, Nike, Marriott, Walt Disney, Salesforce, Air Products and Chemicals, and Applied Materials. Here's a new slide for this week. One advantage of companies with the best moats is, if they pay dividends, they're more likely to increase dividends even during an economic shock when compared to companies with no moat. In this slide, Morningstar shows there are three categories of moats. On top, we have the companies with a wide moat. On the bottom, we have no moat. And then in the middle is the narrow moat. The wide moat is considered the best competitive advantages. Now, this slide shows that during the 3-year COVID period, when supply chains ground to a halt and some companies saw a collapse in sales, about 80% of wide moat companies were able to raise their dividends, despite many companies being in financial trouble. Only 18% or so cut their dividends during the COVID period. For companies with no moat, which is on the bottom of the chart, only 57% or so were able to raise their dividends, while over 30% were forced to cut their dividends. For that reason, many of our strategies only invest in companies with either a wide or narrow moat. While our quality ranking for stocks includes moats, it goes much deeper than just one metric. But if you want a simple metric for quality, moats are a good place to start. Of course, this slide only covers the 3-year COVID period. During normal periods, dividend cuts are much more rare, and on average, companies increase their dividends 5.5% to 6% per year, which is ahead of the historical rate of inflation. So in the comments, let me know if you have any questions, and also let me know what portfolios or investment strategies we'd like to see more of. And finally, here are the places you can reach me: YouTube, obviously, as well as our website, beatthestockmarket.com, LinkedIn, and Twitter. I'll see you again next week, likely with a list of dividend stocks we'll have purchased on Monday. See ya!